Good morning, everyone. Uh, Anybody is there? Okay. Today we will be discussing the topic of evaluating proposal for strategic decision on capital expenditure in an organization. This is an important aspect of finance for manager as it involves making qualitative judgment and assessment based on various factors and available knowledge. So my name is Yasser Gulfraz and I'm your tutor for today's lesson, which is finance for manager, and it's one unit of extended diploma in strategic management. So let's start with our first learning outcomes, be able to evaluate proposal for strategic decisions on capital expenditure in an organizations. So to understand the type of expenditures and the difference between capital and revenue expenditures, capital expenditure refers to the money spent on new non-current assets in a business. It can be for maintenance, profitability, expansion, or other indirect purposes, unlike revenue expenditures, which is regular, and for smaller amount, capital expenditure is expected to generate long-term benefits. uh, Types of expenditures, again, difference between capital and revenue expenditures, differentiate the definitions, decision making, treatment in financial statement. So then is a cash flow management, cash flow forecasts versus cash flow statements, managing inventory, trade payable, trade receivable, etc. Investment appraisal. Anybody can tell me what investment appraisal is? Anybody is there? Okay. Investment, when evaluate capital expenditure proposal, we use investment appraisal technique to determine their potential value to the organization. These techniques compare the expected future income from an investment with an expenditure incurred. In non-profit organization, when investments are not made with the objective of earning a return, investment appraisal techniques can still be used to compare alternative uh, proposal and provide the best value for the money spent. There are several investments appraisals techniques available, including payback, accounting rate of return, net present value, internal rate of return, discount cash flow, or DCF, cost benefit analysis and value of for money. So let's briefly discuss a few of these techniques and methods. So first of all, payback. Payback is simple technique that calculate how long it will take to recover the initial outlay for the investment. It conditions the timing of cash flows, and it is useful for firm operating in fast changing markets. However, payback does not consider the profitability of the investment or the revenues and costs that occur after the payable period has been achieved. So there are few advantages and disadvantages as well. Advantages are include easy to calculate, easy to understand, consider the timing of cash flow, and useful for firm operating in markets that undergo fast change. There are some disadvantages of payback, can encourage short-term thinking rather than long-term planning, does not consider profitability of the investment, and ignores revenue and cost that occur after payback has been achieved. Here is a calculation. For example, it says year cash flow and cumulative cash flow. So if we have a cumulative cash flow of $31,000 at the end of the year 3, and our cash flow is 4 year in $500. The payback period would be 3 years and 10 months. So this means it would take approximately 3 years and 10 months to recover the initial investment of 31,000 pounds, or sorry, dollars. So discounted cash flow, net present value. So another technique is discounted cash flow or net present value. This technique measures the change in shareholders' wealth resulting from accepting a project. The net present value is calculated by finding the present value of cash inflows and subtracting the present value of cash outflows. Positive net present value indicates that the cash inflows from a project will yield a return in excess of the cost of capital, making the project worth undertaking. Conversely, a negative net present value means the project cash inflows will yield a return below the cost of capital, suggesting the project should not be undertaken. So net present value and accounting return rate of return ARR. We will concept of payback period and another factors to consider in project evaluation. We will discuss a bit about them. Let's start with net present value. Net present value, here some advantages. What it is talk about net present value. So net present value is a financial metric that takes into account the time value of money. It allows us to evaluate the profitability of an investment by considering the present value of its expected future cash flows. In simple terms, net present value calculates the difference between the present value of cash flows and outflows. In the net present value is positive, indicates that the investment is expected to generate more return than the initial costs. It a favorable investment. So there are some advantages and disadvantages considered. The advantages are the time value of money, take into account both the timing and the amount of cash flows, and disadvantages of net present value are more difficult to calculate and understand than other methods, or the choice of discount rate used is arbitrary. So any questions so far regarding NPV? Okay. So example of net present value, so or how to calculate the net present value. So year 1 to cash flow factor, present value, PV factor, present value. So if year 1 in cash flow 1000 minus present value, that would be here. This is a chart is showing 10 example of is on 10% rate. Accounting rate of return, sometimes calls the return of capital employed. Is ARR is a ratio that measures the average profits generated by the project relatives to the initial capital invested. It is expressed as a percentage. To calculate the accounting rate of return, we divide the average profits per year by the initial profit and multiply by 100. So in here is the simple, that we have 3 projects considered by BAS holding. So Andover, Bristol, and Carlisle. So by calculating the ARR for each project, we find that Andover and Bristol have a accounting rate of return is 5%. Okay, here the 5% and 5%. Carlisle appears to be better project as it is a higher rate of return, which is 8%. Here is activity. You can calculate by using that formula, which I just here average profit per year initial divided by initial capital and multiply by 100. So calculate the exact payable periods for the following project and determine which project should be paused. So year A is a project B, year A project and 10,000, then year B project is same $10,000. One is a 3,500 pound, then B is 6,000 pound, then 35, 4,000, then 35, 500, and 35, then 35 for 0. So to calculate the project, we sum the cash flows until we reach or surpass the initial investment. For project A, the payback period is 3 years. So that's mean 10,000 plus 35 plus 35. It's a 3 year. Okay. 10,000 plus 35 plus 35 plus 35 here. For project B, the project bat is 4 years, so 10,000 plus 6,000 plus 4,000 and plus 500. So therefore, based on the payback period, project A should be paused as it has a shorter payback period than project B. Here, under the what circumstances might company choose a project with a rapid payback period rather than an with a higher rate of return? This is a question. It says the factor to consider besides payback period. While the payback period provides a useful matrix, it is important to consider additional factors when evaluating investment projects. Some of these factors include risk, cash flows, project lifespan, and discounted cash flow. What are the factors here? So accounting rate of return method, the AR method measure the average annual profitability of investment and percentage of initial. So to calculate ARR in 3 projects here, project A, for project A, ARR 60%. If you calculate for project B, the ARR is 77.5%. For project C, ARR is 30. Based on the ARR method, project A should be paused as it has the highest rate of return. A plan expressed in money it prepares. So by effective running of business management must know where it intend to go. For example, organizational objectives, how to it intends to accomplish its objective. For example, plans, whether individuals plan fit in the overall organization's objectives. For example, coordination. So whether operation conforms to the plan of operations relating to that period. For example, budgetary control is the device that a company uses for all these purposes. Anybody have any questions, or if you have any issues, can see my screen? Anybody's there? Okay. Evaluate business proposals for capital expenditure in an organizations using appropriate financial techniques. Here you can see a simple chat or chart. So section sources or selecting sources of finances. So importance of strategy and objectives when preparing a budget, as will will as well as understanding budgetary control and different type of budgets. Additionally, we will explore various sources of finance for businesses, which are here, and we will discuss further down. So strategic and objectives. Why consider strategy? When preparing a budget, you should always start by considering organization strategy and its objectives. So if this is not done, the budget will work against the strategy. Effective effects. Considering strategy and objectives will affect the way we allocate and cost resources with the organization. It gives us a framework for preparing the budget. What is budgeting control? Anybody can tell me what is budgetary control? Okay. Budgetary control is the useful comprehensive system of budgeting to aid management is in carrying out its functions like planning, coordination, and control. So this system involves a division of the organization into financial sections, which is also known as budgetary centering. I'm just telling you a bit in my own words as well. So preparation of separate budgets for each budget center, such as sales, production, cost of production, purchases, personal, capital expenditures, and cash budget. So next is a consideration of functional budget to present an overall organizational review for the forthcoming budget period, a comparison of actual performance against the budgets to identify various variances, reporting the variances with the prepare analysis to provide a basis for future decisions making and tools. Classification of budgets here. What is the budgetary control? Then classification for budget according to time, according to functions, according to flexibility. So according to time, long-term budget, short-term budget, current budget, rolling budget. Then comes to according to functions. So there are different type of budgets: sale budgets, production budget, cost of production budget, purchase, personal R&D, capital expenditure, cash budget, and master budget. So then it comes to the according to flexibility, fixed budget, and flexible budgets. So here, long-term budget, these covers the extended period, typically beyond 1 year, and short-term budget cover a short period, uh, most often 1 year or less. Then current budget prepared for the current or upcoming fixed fiscal year. Rolling budget, these are continuously updated by adding a new budget period as the current one expires. So you can say also as a mini budgets. So according to functions, sales, production, cost of productions, uh, purchase budget, personal budget, R&D budgets, capital expenditure budget, cash budget, and master budget. So function-based budget, these focuses on basically specific functions on or departments within the organization, such as sale, production, or research budget. Then according to flexibility, fixed budget, and flexible budgets. Capital expenditure budget, this is important budget providing of acquisition of assets necessitated by the following factors: replacement, if you want to replace your existing expenditures, or purchase of additional assets, or installation of improved type of machinery to reduce cost. Then it talks about cost cash budget. This budget gives an estimated of anticipated receipts and payments of cash during the budget periods. So cash budget makes the provision of for minimum cash balance to be maintained at all times. So here is the activity. You can go through and check the sales, purchase, wage, salaries, sundry expenses to cash balance at 1st October will be £15,000. Then opening balance is like a 15,000, then 50% of debtors pay at the end of the first month, 50% at the end of 2 months, then 50%. These are provisions. So purchase or from one supplier who allows a 10% discount receivable. Then new equipment costing £35,000. It buys the assets, so wages are paid, expenses, arrears again, provisions. So August and October's are 5. So required prepare a cash budget for 3 months ending 31st of December. Comment on the position of the company. So here is, you can see as well, receipts, then payments, then closing. Okay. Here is calculating the sale and calculating the purchase. Next is sources of finance. So there are various sources of finance available to business. When firms require funds, they can consider both internal and external sources of a source of finance. So internal source of finance, when we talk about internal source of finance, there are many, include owner investment, personal source of finance, retained profit, sale of stock, sales of fixed assets, and debt collections. So owner investments, funds contributed by the owner or shareholders, are retained profits generated by the businesses that are reinvested instead of being distributed as dividends. Then sales of stock, selling existing stock or inventory. Then sales of fixed asset, which is disposing of non-current assets to generate cash. Debt collection, recovering outstanding payments from customers. So these internal sources can provide businesses with the necessary funds to meet their financial requirements. Any questions so far? Any question about internal sources of finance? Okay, next one is external sources of finance. There are, if we talk about external sources of finance, bank loan or overdraft. So I will explain in my own words as well. So if you have any questions, you can ask as well. So bank loan or overdraft, this type of financing provided long-term option for startups. Bank specify the loan period, interest rate, and repayment terms. Additional partners, bringing in additional partners who invest capital in the business is another source of finance. Then share issues. A startup can raise funds by issuing shares to external investors. Friends, family, or business angels are often the main source of outside investment. So while this can bring in expertise and capital, it may also result in a loss of control for the entrepreneur. Then leasing allows business to acquire assets by making regular payments over a specified period. The option is useful for acquiring assets without large upfront costs. Then is a hire purchase. Similar to leasing, hire purchase allows businesses to acquire assets by making regular payments. However, ownership of the assets is transferred to the business at the end of the payment period. Then mortgages, business can secure a mortgage to finance the purchase of property or real estate. Then trade credit refers to a suppliers allowing business to delay payment for goods or services. This can help with cash flow management to providing short-term financing. Then is last one is government grants. Some businesses may qualify for grant provided by the governments or other public institutions. These grants can be used to fund specific project or institutions, or projects or initiatives. So external source of finance, bank loan, share capital, So financial management in decision making and its impact on the strategic direction of a business. Financial management plays an important role in ensuring the efficient requires here and development of financial resources. Uh, Financial management plays an important role in ensuring the effective acquisition and development of financial resources to achieve the objectives of a business. And it involves decision making in three key areas, which are investment, finance, and dividends. So the nature of financial management is concerned with an efficient acquisition and deployment of both short and long-term financial resources to ensure the objectives of the enterprise are achieved. So decisions must be taken in a three key areas, as I said, investment, finance, and dividends. So investment, both long-term investment in non-current assets and short-term investment in working capital. Then finance, from what sources should fund be raised, and dividends, how should cash funds be allocated to shareholders, and how will be value of the business to affected by this. Uh, Investment decisions, as a financial manager, it is our responsibility to ensure that just a moment. Sorry about that. So yeah, where I was. Anybody can hear me? Okay. Yeah, when it comes to investment appraisal, we need to consider the long-term plans of the businesses and identify the right projects that will help us meet our financial goals. In most cases, these projects will involve the purchase of non-current assets. Uh, just hang on for a minute, please, guys. Sorry, guys, it was just I was uh, basically message from a student. He wants to join, so I think so. He just missed my lecture. So anyway, so where was guys? Yeah, to investment decision. When it comes to investment appraisal, we need to consider the long-term plans of the businesses and identify the right objectives that will help meet for financial goals. In most cases, these projects will involve the purchase of non-current assets by carefully evaluating and selecting these projects. So we can ensure that our financial objectives are met. So any questions so far? Okay, any question about decision making or financial management? Okay, so next is financial consideration impact upon services users. So what is financial considerations? Anybody can tell me about financial considerations or economic indicates? So financial consideration that impact services users in the health and social care sector, such as care tech in this sector. Financial consideration, also known as economic indicates, influence the level and kind of access and support individuals receive from the health system. These indicates indices are determined by the central government, individuals, health organizations, and the individual themselves. To obtain services from the central government, individuals undergo assessment to determine their needs and evaluate the risks they face in maintaining independence. Based on these assessments, the government decide in individuals are eligible for support from social care and assigns them a priority category. The fair access to care services framework guides the eligibility criteria, which are divided into four bands: critical, substantial, moderate, and low. Individuals assessed as having substantial needs are allocated social care services. However, indicate funding has led to the introduction of theirs hold. So which means some individuals may not receive the support they require. Recommendation. So improving of the quality of health and social care services, one of the suggested approaches in the implementations of a payment by a result system. This government policy transferred the risk and responsibility from the government to healthcare providers, motivating them to improve their services to achieve excellent value for money. By implementing such a system, care tech can ensure that all services provided meet the required standards and delivered anticipated results, providing value for money and satisfying service users. Other recommendations, including the benefit cap, which aims to control the overall cost of social care by limiting the amount an individual can receive in benefits, and identifying overseas visitors and changing them accordingly to recover the costs of their healthcare. Additionally, the equity and excellence policy, known as liberating the NHS, focuses on improving the quality and effectiveness of healthcare services by empowering patients and healthcare professionals. Assess the impact of business proposal on the strategic direction of a business organization, criteria, poor objectives, and improved objectives. So specific, measurable, achievable, relevant, time bounded. So improved performance, improved profit before tax, improved profit before tax by 20%, improve profit before tax by 5%, reduce debt by 15%. Then improved objectives, profit before tax, improve profit before tax, improve profit before tax by 20%, improve profit tax by 5%, reduce debt by 15%, then reduce debts by 15% within 18 months. Straight analysis. Strategic analysis plays a very crucial role in this process, as it involves examining the current strategic position of the organization by collecting information about the organization and its environment. We can make rational decisions about future course of action. NHS England budgets, the healthcare sector, the England budget plays a significant role in shaping the strategic direction of organizations. The funding state settlements for NHS England announced an increase of 3.4% in real terms over the next 5 years, equivalent to 20.5 billions by 23 and 24. So, however, due to higher than anticipated inflation, the cash terms commitment for the next year will be lower than initially expected. It is important to note that the funding settlements figures may be updated in the future to align with the real terms increase commitments. NHS England funding settlement. You can read these calculations. Then ACC article on, and if you want to read some articles about investment appraisals, then you can go to ACCA websites. Highland Council case studies. For case studies, you can search. You can see the website businessstudies.co.uk investment BG Groups. Managing a store relocation project, a Marks and Spencer case studies. Also, you can visit the website tutor2u.net for the quiz. Here are some references are so here. So that's it for today. Any questions or anything else? Okay. So if you have any question, please drop me an email at yasir@ukversity.co.uk. So that's it for now, and we'll discuss our next learning outcomes tomorrow at 11 o'clock. So see you at 11 tomorrow, and bye for now. Thank you very much.